From unprecedented AI energy demand to the continuing conflict in Iran, energy is one of the highest demand sectors in the entire market, and these 4 stocks are cashing in on that demand. Joining us today are Dan Ferris from Stansberry Research and Luke Lango with InvestorPlace. Guys, such a treat to have both of you on today to really talk about these 2 major catalysts for the energy sector. Dan, I know your specialty is the conflict in Iran and oil prices, and Luke, you are going to dive into that AI energy demand a little deeper. We'll get to the AI story in a minute, but Dan, let's start with you to this ongoing, continually reigniting conflict in Iran. Let's talk about what that's doing to the energy sector.
I don't think the Iran war is a sort of quick hit and it's done and then we're all back to normal and oil prices will go back down and everything will be fine. On the contrary, 1 or 2% of global oil production could be permanently offline. We don't really know, but I think some amount will be permanently offline. And a lot of it is damaged and won't be started up. Then there's just the fact that the U.S. and Israel have bombed the heck out of the place. So refiners have been bombed. We've all read about this stuff. The helium supply, the fertilizer supply, the liquid natural gas supply, it's all been bombed, to some degree or another. And never mind the difficulty of getting anything through the Strait of Hormuz, it continues to get worse. And I think even if the war stopped tomorrow and there were peace and Hormuz opened and Bab el-Mandeb opened and all the rest of it, you would still have a substantial impact to energy and global commodities. At this moment, Bridget, it's gone on longer than anyone thought, right? The market was pricing in peace, and now we're back into the mid-80s with crude oil. So that's the way I see it. I think it's a higher for longer situation with energy prices.
Yeah, right. Not only has this war gone on much longer than anticipated, keeping oil prices higher for even longer, but that is all coming at the same time the U.S. and really the entire world is facing this unprecedented demand for energy to power the AI story. There's so much demand for electricity and really power of any kind for the AI build out. So Luke, we've covered that Iran conflict catalyst for the energy sector. Let's dive a little bit deeper into the AI perspective and what it's doing to the energy sector.
We were unprepared for this moment as an economy. We basically spent the last 30 to 40 years, definitely since the dawn of the internet, but arguably before that, convincing ourselves that we are a digital services economy. And so we invested everything and told all of my whole generation was told, become coders and you're going to be set for life. And now the coders are all getting fired. We were woefully unprepared for this moment. We convinced ourselves we're a digital services economy. We invested in digital services. We built digital services businesses. We told people to be digital service employees. It was all digital, right? We didn't need the physical. It was laughed at to be a plumber. It was laughed at to be in construction. It was that was the uncool stuff. That's what the uneducated people did. That's not what, and so all of a sudden we're in this moment where we need a lot of physical stuff and we are so unprepared for it. Right now, we're having plumbers and construction electrician people that are making $300,000, $400,000 a year, and we have unemployed people out of Harvard with coding degrees that don't know where they're going to end up. And so as a society, we were so unprepared for this moment. And that's why we have these massive supply-demand imbalances. And of course, if you are on the supply side of that, then you're going to make a lot of money because you're going to be sold out. You're going to be able to sell whatever prices you want, high margins, high profits, high cash flows. And so that's why when we look at, you want to be aligned with the CapEx takers, well, which CapEx takers specifically? The hard asset ones. Because as a society, as an economy, as a civilization, we were just woefully unprepared for this moment where we need a lot of physical stuff. And we essentially underinvested in physical stuff for 30 to 40 years. And now we have to overinvest for the next several years, probably up to a decade to compensate for that.
Yeah, and we're absolutely seeing that in the market. All of those hard assets, the ones that are actually physically doing the building of this new AI infrastructure, are the ones that are truly winning in the market right now. We're going to get into 4 of these names right now that are really good hard asset opportunities for investors. I know it's also something that the 2 of you dove into in this special report, really talking about where the money is flowing for that next 5 to 10 year period and where you're going to continue to see a lot of growth. If you want to check out that special report from Dan and Luke, scan the QR code or click the link in the description to get that special offer and learn more about the different stocks they're recommending that are specifically on this strategy of looking where that money is flowing right now and will continue to flow for the next several years. There's also some really big players that are already flowing their money there. And so following the money is such a good strategy too. That's all in their special report you can get with that link. All right, guys, we have a list today of 4 different stocks we're going to cover. The first is a group of 2 stocks. So let's get right into this list. Dan, what is the first group of stocks that you're sharing today?
The refiners, Valero and Marathon. Valero is VLO, Marathon is MPC, and they both have about 3 million barrels a day capacity. But the important thing here is that you really can't build a refiner in the United States anymore, including the America First refinery that is purported to be underway in Brownsville, Texas. It's my view that they'll never build it. They've been trying to build a pipeline on that site since 2016, and they can't even do that. They couldn't build a pipeline and a terminal and storage there, let alone a refinery. You can't. You can permit a refinery in the U.S. You can't build one. So I want people to own refineries, and at this moment, of course, they're gushing cash flow that they won't be able to invest in building a new refinery. So they're going to buy back shares and pay dividends. I'm convinced that the money will not go into new investment. It will go into shareholders' pockets. That's the basic sort of a top-down case for the refiners. They've soared 80% since the beginning of the year, and it looks like, whoa, boy, I missed it. No, I don't think you did, actually.
Yeah, that was going to be my big question, is the concern for investors. I know a lot of our viewers, whenever they see a stock that's towards the top end of its 52-week range, they've seen a stock that's gone up 90% year to date. They say, why would I get in now? Talk about what you think about the long-term growth here and how much more growth could be to come. I also think you look at the earnings reports for both of these stocks. Clearly, the money is coming.
It's not growth that I'm looking for, although there will be probably on-site capacity expansions because they can do it. They have the sites. But what I'm saying is they'll gush so much cash that can't be invested anywhere. They'll have to pay it out to shareholders. Their share counts will have to shrink. Dividends will have to go up if they want to do it that way. It's like this gushing cash cow trade that will be more persistent than I think anybody looks at it and says, oh, it's up 80, 90%. Too late. I don't think so.
An interesting thesis for this one, or for both of these names, just the fact that they have so much cash and nowhere to reinvest it.
If I've learned anything about them over the years, if you can't point to some way in which the supply is seriously crimped amidst ongoing demand, and gasoline demand has fallen slightly since 2019, diesel demand continues to rise. That's another thing. I found these things because I was looking at the fact that there are different numbers on this too, between actually as low as 3,000, as much as 5,400 data centers in the country. 95% of them use diesel generators. These are massive, like 2 megawatt diesel generators, and they have like a dozen or two of them on site. And they're doing the same thing with gas turbines, they're hauling them into these places. So there's this baseline of demand because diesel fuel goes bad every 6 or 12 months and you got to replace it. And you got to run the diesel generator for so many hours per month or else the fuel will kind of foul it up. There's a kind of a tail risk insurance aspect to it as well.
Yeah, I think the AI story and the energy demand is absolutely there. We know that diesel and oil also plays a role in fulfilling that need for electricity that the AI demand is bringing so much right now. Luke, that kind of transitions well into the stock that you have for this list today of those real kind of picks and shovels, boots on the ground companies that are doing a lot of work tied to this AI build out. What's the stock that you're talking about today, Luke?
Yeah, so first I just want to say you mentioned that thing about your readers or viewers writing in and saying don't want to buy a stock at a 52-week high. Well, the most likely thing a stock does after making a new high is make another new high. Momentum is very real, and in this market, it is very, very real. So I'm actually giving a recommendation here that is a stock that has run to 52-week highs. It's been making 52-week highs at the 52-week highs for a very long time, and it'll keep on doing so for the next 6 to 12 months, I think, if not a little bit longer. And that is GE Vernova. Ticker is GEV. So GE Vernova essentially makes the physical energy equipment, you could call it, stuff like gas turbines, transformers, grid gear, that turns electricity into something that a data center can actually use. So essentially like that transmission, if you will. AI, the bull thesis, obviously 400-foot view, AI needs way more power than anyone planned for, and which we were woefully unprepared for, as I mentioned earlier. The grid cannot build fast enough, so tech companies and utilities are buying this equipment, these turbines and transformers and grid gear, et cetera, as fast as GE Vernova can make it. And the numbers here are pretty outstanding. If I just kind of pull up their recent earnings report, they do report earnings very soon, but their most recent earnings report was just outstanding, where we saw Their electrification segment booked $2.4 billion in equipment orders in Q1. That is more than they booked all of last year. So they're doing more data center business in electrification in one quarter than they did all of last year. The electrical equipment business posted 86% organic year-over-year order growth in Q1. The backlog rose from $25 billion a year ago to $42.4 billion in that quarter. Overall backlog rose from $116 billion to $163 billion. $18.3 billion in new orders in the quarter, which is a 71% increase year over year. It's more than just story here. There's massive numbers to back it up. And again, I think that this infrastructure build out continues. Power to me is the ultimate bottleneck, and GE Vernova solves a very important problem in that power specific bottleneck of the AI infrastructure build out. So I think the stock is going to continue to do well, be fundamentally supported by really strong revenue growth, margin expansion, and ultimately earnings growth. The chart's really pretty. It just keeps on moving up and to the right. Had a little bit of a 10-15% pullback and then immediately recorrected and is back to new highs essentially, or very close to. This is a buy on dip stock, so long as the build out continues, which again, I think it will continue for at least the next 6 to 12 months, if not longer than that.
I love that idea. I love it. One of the reasons I love it is because there's 3 of these companies in the world control 2/3 of all the turbines: GE, Mitsubishi, and Siemens. And it probably takes a little more than 5 minutes to build a new plant, to build natural gas, like utility scale natural gas turbines. And it takes a lot of capital and a lot of time and a lot of materials. It's what Luke said before. We haven't built stuff for a long, long time.
Yeah, and this one, like you said, Luke, has been such a strong performer for a very long time and continues to grow and reach new highs. Again, for investors who are looking for a stock that's not at those new highs, wait around for this last one. We have one that the chart looks a little bit different, is a much smaller company that we're getting to for the third stock on this list today. But Luke, a couple follow-up questions about what kind of growth investors can expect from a stock like this during this kind of intense AI infrastructure build-out spending that we're seeing right now. Every retail investor wants to find that stock that's going to go up 1,000% in a year, whether that's the memory or some different energy. We've seen Bloom Energy go crazy this year. Is that what we're going to see with GE Vernova, or what kind of growth can you expect, not just in the next 18 months, but the next 5 years for this company?
It's not a SanDisk or Micron type story where you're going to get 100 or 200% or 500% revenue growth, or like a Nebius where you just get those massive triple-digit revenue growth numbers, this huge margin expansion, and these sometimes 1,000% plus EPS growth numbers. GE Vernova is not that. And that's actually kind of a good thing. It's a feature, not a bug, right? Because when you have a stock like Micron or SanDisk or a Bloom Energy that goes up like that, they also go down a bunch too sometimes. And we've seen that recently, right? I think Micron had a 25 or 30% haircut recently, if not bigger. SanDisk, I think, was even larger than that. They're high risk, high reward plays. GE Vernova is a bit more lower reward, but also a lot lower risk. Like, this stock tends to bottom after 10 to 15% pullbacks. It doesn't have 20% bear markets. It doesn't have these 40% crashes that you can sometimes give with some of those higher beta names. This is a company that when you look at its revenue growth numbers, it's probably over the next several years. I mean, we're modeling for like mid-teens to high teens revenue growth, so 15, 16, 17% per year. That's really, really solid. We think margins can continue to expand. They're around low 20s right now on gross margins. I think that can get up to high 20s, if not low 30s. EBITDA margins should expand with those gross margins and with economies of scale. When you have a high teens revenue grower that's going to expand EBITDA margins from, let's say, 8-9% to 20, 22, 24%, you're looking at, maybe a 30 to 40% EBITDA grower, which is massive EBITDA growth. So that's 30 to 40% returns per year if the multiple stays consistent. And the multiple on this one is 35.5 times forward EBITDA, which is a little rich. So maybe that compresses a little bit, but I think this is a name that can get you 20 to 30% returns per year compounded, so long as this boom persists with kind of lower volatility attached to it. You're not going to be subject to those 20%, 30% drawdowns that some of the other names give you. And so it's a nice complement to an AI portfolio. It's one of the reasons we like it. We think it's a steady compounder over the next several years.
I don't want to miss talking about the earnings report because we're recording this on Tuesday, just a few hours before the new earnings report comes out on Wednesday morning when you all are watching this video. So just want to talk about what to expect after an earnings report. Whatever comes out Wednesday morning, do you think if we have another blowout earnings report, the stock could react positively, negatively? Is it hard to predict what can happen post earnings report release for a company of this size?
I mean, I would love for it to react positively. I have a feeling it's going to react negatively. early, and that's going to be a great buy the dip moment. Because, I mean, when you look at what's been happening in the AI complex, when a CapEx taker reports, regardless of how good the numbers are, that they're selling off. So TSMC had a great report and it sold off. ASML had a great report and it sold off. Samsung provided a great update and the whole complex sold off on that. So it doesn't matter on the taker side. Right now, the fears are on the spender side. And so I don't think that we're going to get this broad rally back in kind of these CapEx takers until the spenders step up to the plate and hit home runs, which I think they will. So I think ultimately this is probably one that drops after earnings, maybe a 5-10% pullback after earnings, and that's a great buying opportunity ahead of the Microsoft report, ahead of the Alphabet report, ahead of the Meta report, ahead of the Amazon report, where they'll probably reaffirm, if not hike, their 2026 AI CapEx plans and provide directionally bullish commentary on 2027 and 2028 CapEx plans, and that reignites this whole rally.
I think looking at any dip during earnings as a buy opportunity is a great advice, Luke, because I think we're already seeing lots of big money doing that right now. The billionaires and the big money flowing right now is into names exactly like this, along with some others. And that is exactly what you outline in the special report that Dan and Luke did together. Again, if you want to check that out and look at all of the names that they are looking at, not only for their signals of long-term growth over the next few years of this AI infrastructure build out, but also following where the big money is moving and why they're investing so heavily in this area. You can scan the QR code or click the link in the description to get that report right now. It's a special offer only for the viewers of this video, so take advantage of that while you can with the link in the description. All right, Dan, let's get on to this last stock that you have for us today, and this is very different than the other three that we have looked at, a much smaller name.
Yeah, Ecovist, ECVT is the ticker. Ecovist is sort of when I went down the refinery rabbit hole, I found it because it's the largest regenerator of sulfuric acid in North America. Sulfuric acid is the most widely produced chemical on Earth. It's in a lot of stuff. 50% of the demand is fertilizer. A lot of it is used in the energy complex and in chemicals. And in the energy complex, the reason why they regenerate it is that they get like 88 or 89% pure sulfuric acid as a waste product, a spent sulfuric acid product from refineries. Refineries use it. They put it through a bunch of heat and chemical processes that we don't want to get into, and they clean it up and purify it. And then they send 98, 99% pure sulfuric acid back to the refinery. And the refinery uses it to make something called alkylate. It's an essential part of gasoline now. The gasoline in your tank is not one thing. It's 5 things or 5 or 6 things. And one of them is something called alkylate, which sort of raises the octane rating and lowers the sulfur content. The regeneration side of the business is a cash cow. They don't just regenerate, they own the whole supply chain. They own the tanker cars. A tanker car loads up with spent sulfuric acid at the refinery, goes back to Ecovist. Ecovist purifies it, sends it back. I don't see big growth here, but it's a cash cow situation. They're the biggest one in North America. They've got the market sewn up. The market share is in excess of 50%. And it's just going to keep making money. The other side of the business, and that's about 45% of revenue, the other 45% is what they call virgin sulfuric acid. You start with sulfur and you just make sulfuric acid. And that's used in all kinds of things. Like you can't mine these lower grade copper mines without it, right? They use sulfuric acid to leach out the copper from the ore. So we need a lot of copper, so we're going to need a lot of sulfuric acid. Ecovist, I think the growth in Ecovist comes from the virgin sulfuric acid, and they're acquiring more of that capacity throughout North America. So they'll acquire it, they'll grow it organically, and I think that part of the business will become much larger over time. And I think it's kind of a sleeper. I don't think people have really caught on. I think when everybody knows about refiners and everybody knows about crude oil. I don't think people have put sulfuric acid together. It doesn't seem like it yet. So you can still get it at a pretty good valuation.
Yeah, this one not only has that Iran war tie-in, but it also is tied to that AI infrastructure build-out and the demand for materials, because copper is a key player in so much of this build-out happening right now, and the whole electricity energy story as well. So it's an interesting name. And again, I totally agree with you. It's one not very many people are looking at. And if you're looking at where the chart is right now, this one's actually down a little bit. It's on about a 9% pullback over the last 3 months, even though it's still up very much for the year. So it's a really interesting time to be looking at this name. Also nice to know that their earnings are starting to come in. They're starting to see that growth.
The revenue was like 700 something last year. It'll be 9 something this year. A lot of that is is sort of cost pass-through. The contracts are these long-term 5 to 10-year deals. I mean, you're physically hooked to the customer, and you got a 5 or 10-year contract that just renews, because what else are they gonna do?
4 really interesting names for our viewers today. Thank you both for the time and going through some of these really boots on the ground infrastructure plays so closely tied to the energy story and the AI build out and what's happening in the Iran war too. Thank you both for the time today. If you are interested in more AI infrastructure stories and the incredible growth this area is seeing, make sure to watch this video. We spell out some of those other major bottlenecks in the AI build out. And this is from Keith Kaplan. Make sure to watch the whole interview here.